All right. Well, welcome everybody. This is always a great time to have First Trust come and really tell what's going to be in their viewpoint, what's going to be happening the next quarter, the most part of the next year, this year coming up. So we have a great person for that. Bryce Gill. He's the economist for First Trust, and he has a lot of knowledge. He's been there quite some time. So I'm looking forward to his knowledge, and then he said he'll hang around for a few minutes just to take some questions from you all. And there are some that you typed in some questions. I'll go ahead and get that to him later. But until then, we'll welcome Bryce.
All right. Well, hey, thank you so much for having me. It's great to be with you and your clients here this morning, and obviously a very timely, I guess, period to do it in, right? I mean, there's been a lot of chaos in the economy, the stock market. We have like a stock market correction going on. Obviously, market's been bouncing back a little bit recently. People are worried about tariffs, everything else. Really, since Donald Trump got reelected, I think for most people, it's been like drinking from a fire hose, like all the information coming in, the new people being appointed to the government, the new economic policies, all the behind the scenes things happening in Washington, D.C. And so I figured maybe like the best thing to do today is just focus and drill down on the things that really I think matter in all of this for people's portfolios, right? And again, when there's so much information available, I think it's easy to get lost in the noise here. What really matters for the stock market, for the bond market, for people's financial asset values are two things. One's going to be profits, and that's going to be really based on, hey, is the economy growing, or are companies, seeing their markets expand, or people going out and buying more because their incomes are going up? And the other side of it's going to be interest rates, and interest rates, generally speaking, are going to be based on what's happening with inflation, what's happening with the Federal Reserve. And so I'll tell you guys right now, just to get started, I'm not really worried about the profit side of the U.S. economy this year, okay? And I know there's concerns about a recession, and I'm definitely going to address all of that today. But I think generally speaking, hey, the economy is going to expand, companies' profits are going to go up. Overall, we have a lot of huge advantages structurally for ourselves here in the United States. That tells me, hey, there's not much to worry about with like the economy continuing to expand. It's really the interest rate side of the picture that I think is adding all this volatility to the market. So inflation is still too high. People are concerned about tariffs, what that's going to do to inflation as well, right? Slap in taxes on goods as they cross the border, could potentially increase prices. We'll touch on that. We also have the Federal Reserve recently pausing its interest rate cuts. And on top of that, we've got a huge budget problem in the United States, right? It wasn't so much an issue when interest rates were zero. We had $30 trillion in debt. But hey, now all of a sudden, interest costs have spiked. Interest is now the biggest single line item in the budget. It makes investors a little bit more worried, and that worry translates into big shifts in interest rates as well. So I want to cover the big stuff, guys, touch on what's going on with international trade, this reshoring situation, bringing business back into America, the tariffs, the trade policies out of the Trump administration, what that means for the economy and inflation. Then touch a little bit on like Doge and deregulation, and then maybe finish it up with just some thoughts on the budget. We'll wrap it up then and do some Q&A. So with that, I'm going to go ahead and try and share some slides. Just let me know on your end if you can see this okay, guys. I want to make sure it's coming through all right for your clients as well. Good. Okay. You got the thumbs up there. All right. Well, okay, guys. Well, I want to start with inflation because I think inflation is sort of the context of everything we've been dealing with in the stock market and the economy. Really, since COVID, we saw inflation hit a 40-year high at around 9%. Now, we've made a ton of progress since then, right? Inflation today is around like 3%. So it's come way down. We've made progress, no doubt about it. But at the same time, hey, that last mile, and the Federal Reserve wants to see 2% inflation. I think that's going to be the toughest part of the problem to solve, is getting from where we're at today, around 3% to 2%. And I'll first start by saying, hey, I think inflation's just been massively overcomplicated over the past few years. Inflation's frankly not that complicated of a subject. It's just too much money chasing too few goods. And during COVID, we printed $5 trillion and shut down the economy, right? So it was COVID. It was the COVID response that caused inflation to get as high as it did. Post-COVID, we stopped printing money. We reopened the economy. Inflation's come down, right? And so again, it's just going from that last bit, 3 to 2%. That's been the challenge here. The Fed has been unable to like declare victory. They started cutting rates last year, but they've had to pause. And so, guys, I think the Fed's going to continue to have a lot of trouble with rate cuts. And the reason why is we totally reoriented global supply chains in the post-COVID world and begun bringing a lot of business back to America. And so a lot of people give Paul Volcker credit for fixing inflation. He sort of is like in the mainstream narrative. He's the guy that hiked rates to 20% in the early 1980s. So if anybody's on this call, you had like a mortgage rate that was double digits when you bought your first house. It was Paul Volcker that did that. And sort of the popular narrative, hey, he beat inflation with high interest rates and we had low stable inflation ever since. I think one of the reasons why inflation was so low and stable for so long was globalization. Okay. Think about what happens the past 30 years. The Soviet Union collapses, half the world joins the Western markets. We unite North America in a free trade agreement with NAFTA. It's the biggest one in world history. And then, hey, China joins the WTO, right? They bring 1 billion people in their labor force with them. The United States got access to a lot of cheap labor and materials in a really short period of time. That's like the bottom line. And so if you can cut your labor costs by 90% by moving your factory to China, it's going to be great for your profits as a business, obviously, but I think it's also going to be really good for domestic inflation rates, right? You can pass on those cost savings to the end consumer in America, and overall, the inflation rate in the United States is going to fall. And so, hey, I think cheap labor, globalization, sending jobs all over the world to the lowest cost areas, that really helped with inflation the past 30 years. The trade-off is supply chains get really long and complex. You deindustrialize as a country. And then if, a major geopolitical event like COVID comes along, the whole system, it might be efficient, right? But it's really fragile and it sort of falls apart. And so post-COVID, there's been a huge effort, especially in the United States, to bring back really critical or national security type industries back to the country. So think semiconductors, green energy, pharmaceuticals. With the war in Ukraine, there's been all kinds of concern and talk around the defense base, right? Like we don't make enough artillery shells here and things like that. So the chart I have on the screen for everybody to show you this isn't just political rhetoric, we've seen something pretty dramatic happen recently, is just data on factory construction in the United States. And when you look at this chart, what you see is factory construction has basically tripled in the past 2 years in the US. So we are bringing a lot of business back home. We're reshoring. We're making our supply chains more resilient. But the trade-off here is, hey, if cheap labor and globalization made everything, inflation 2% the past 30 years, if we're not going to reshore everything and pay Americans to do all of this, it's going to add to inflation. It's going to raise that baseline inflation rate up. And so I think what we're dealing with today is just sticky high inflation because we brought all these jobs back home. Normal people are seeing their pay rise more rapidly. If you go to negotiate with management now, in the past, you'd go sit down in a labor negotiation and they'd basically, put the trump card on the table, no pun intended, by the way, of, hey, we're going to move the factory to China, right? That's not an option anymore. And so big pay increases for normal people. Those people go out and spend the money in the economy. I think that's what's driven up the baseline inflation rate in the United States. When a Wall Street CEO's pay, CEO gets all the pay gains, they don't buy consumer goods for the most part, right? That's what happened after 08, 09, the financial crisis, when normal people's pay goes up rapidly because they have more labor negotiating power, jobs are coming back in the United States. Hey, that adds to CPI inflation. And that's when we're talking about inflation in the US, we're typically talking about CPI. So listen, Donald Trump, and I'm going to get to tariffs here in a second, I think wants to incentivize reshoring. He's been talking about it since 2016, but it was really, in my opinion, COVID that changed the game here, changed the status quo, made this a bipartisan issue. I think, counterfactual world, Kamala Harris had won. I think we'd still be seeing reshoring booming in the United States. It just comes down to how the individual parties want it to happen. But I think we've begun to see a lot of business come home. It's raised up that baseline inflation rate. I think the Fed's not going to be able to cut interest rates because inflation is going to stay high due to reshoring and changing global supply chains. So that all being said, guys, I mentioned, hey, I think both parties kind of want to do reshoring, right? And the big difference isn't really about reshoring. It's about how they want to incentivize it, okay? So the Democrats, generally speaking, kind of favor what we would call industrial policy. So a lot of people on the call have probably heard of the CHIPS Act or the Inflation Reduction Act. These are big like pieces of legislation that essentially incentivize companies to bring production back home, right? You give Intel a tax subsidy or something, and then they're going to build a factory in the United States. The problem with industrial policy, it's really expensive, right? So the CHIPS Act, the Inflation Reduction Act, going to cost about $3 trillion with a T dollars over the next 10 years. Conversely, and given our budget situation, which I'll talk about later, hey, expensive actually matters for the first time in a long time. Conversely, the Republicans kind of favor tariffs, okay? And tariffs are basically a border tax. You tax goods as they come into the country. If you do that, all of a sudden, hey, companies that make their goods abroad are going to say, hey, maybe we should build a factory in the US to avoid these border taxes. So that's sort of the idea between the two. Now, listen, there's been a lot of talk about Trump's tariffs. We all sort of knew he was going to do tariffs when he came into office. He did them his first time around. And so I figured I'd start out by giving you guys just kind of a quick historical rundown of, the history of tariffs in the United States and maybe the economic impact we're actually looking at, okay? Because there's a lot of concern around tariffs causing a recession. And so what I did here is I charted out tariffs back to 1790. So basically just post US becoming a country. And early on in our history as in the United States, we're collecting basically all of our government revenue from tariffs because the only easy way we have to collect revenue is just put somebody at like the port and tax ships as they sort of sailed in, right? It's just like the easiest way to do it. Over time, though, tariff rates kind of come down in the United States, okay? Specifically, the big things that cause us are initially like the Civil War in the US, okay? That's when the first income tax gets put in place. And guys, the history of the government is when we have like a major new tax get put in place, it typically never gets removed, okay? And the Civil War is actually a weird example where that's not true. The income tax goes in place and it actually gets removed post-war. But we also add a lot of other excise taxes, different ways to fund the government and the military during the Civil War that don't go away. And so we diversify our government revenue, right? We're not just collecting everything through tariffs anymore. Ultimately, hey, World War I happens. We implement the income tax and leave it in place. Income tax becomes a huge part of how we collect revenue for the government. Federal Reserve gets created. That creates another source of revenue for the government. They can kind of just print money to pay for things. But over time, hey, tariffs go down in importance, right? And post-World War I, we had a huge incentive to keep tariffs low because we were basically selling more material and supplies to everybody in Europe, right? So we had a huge incentive in global trade going on. Post-World War I, though, hey, everybody's having their economies slow down, these export markets disappear. All of a sudden, hey, people are raising their tariff barriers again and lead up to World War II. You can kind of see that happen here on the chart. And then really post-World War II, guys, tariffs go down for the past 80 years. And you can see kind of what's happened. They hit a record low around 2016, 2017 under Donald Trump's first term in office, and they've been going up since then. And so first thing I want to point out, guys, is just in the context of history, just assuming all these tariffs go into place that Donald Trump is talking about, you can see where that puts us in that last little bit on the chart, right? That's 2025 there. We go to about 8% average tariff rates, which is, where we were in like the 1940s, okay? My view, guys, is in the context of history, I don't think like a tariff rate of 8% is enough to cause a recession in the United States, okay? And that's the big concern here. I don't think it'll cause a recession for several reasons. One is most of what we buy in the United States, most of consumer spending is things we buy from each other. Okay, it's services, things that don't get touched by tariffs or import taxes. Think haircuts and movie tickets and a restaurant meal. Back in like the 40s, back in the 20s, back in the 1800s, most of what we were selling was like industrial goods and agriculture, right? Things that we're exporting around the world. It's not really the case anymore. If you assume all these tariffs get put in place and stay in place for the foreseeable future, the best estimates say the impact on the US economy is about negative 0.5 percentage point of GDP. So a very small overall negative impact, assuming all these tariffs get put in place. And I think most of them are a negotiating tactic, okay? The reality is we buy way more from everybody else than they buy from us. And so if you look at the same impact of those tariffs on, let's say, Mexico, it's negative 5% of GDP for them. So 10 times the effect. If you look at the impact on Canada, it's minus 3% of GDP. So about 6 times the impact. And so I think most of these things, maybe they get put in place temporarily. I don't think they'll stay in place permanently. And even assuming the worst case scenario that they do stay in place permanently, they have a relatively small overall impact on the US economy because most of what we buy is things that we buy from each other. Guys, I think the inflation question on tariffs is also relevant here, okay? I don't think tariffs can cause a recession, but hey, we're already dealing with kind of a high inflation rate. The Fed hasn't been able to cut interest rates. Man, if we add a bunch of tariffs, doesn't that add to CPI inflation, like headline inflation rate, make it go up? And, interestingly, okay, you tax something at the border, you make it more expensive, right? If I tax a washing machine 25%, the washing machine is going to be more expensive to the US consumer. What's interesting, though, is, hey, if the consumer doesn't see their budget change, they just have to take that money from somewhere else in their budget to pay for the washing machine. And so ultimately, in order to see like prices go up across the board, and the CPI index, when we talk about inflation in the United States, it's not just one or two goods, right? It's thousands of different things that we buy. I don't think tariffs alone can make the overall CPI inflation rate go up. I think basically, hey, you pay an extra 25% from a washing machine, you just have to pull that money from somewhere else in your budget. Maybe you're spending less on movie tickets or airplane flights or restaurant meals. And so inflation tends to go down elsewhere or slow down elsewhere. And on net, overall inflation, that like headline number, that 3% number you're going to see on the news, doesn't change from tariffs. It just redistributes where the inflation is happening in the overall basket there. And so I would say, guys, we have a recent historical example of tariffs being put in place. And empirically speaking, we didn't see them raise the inflation rate. And that was Donald Trump's first term in office, right? He raised tariffs on washing machines, solar panels, steel and aluminum, all kinds of different stuff. The CPI inflation rate was 2% before the tariffs, and it was 2% roughly after the tariffs. We didn't really see anything distinctly change. So I think tariffs can have impacts on individual things. The overall headline inflation rate, I don't think tariffs are going to have much of an impact. So I think what this does is it incentivizes reshoring. It brings things continually back to the United States. More demand for U.S. labor, reshoring of factories, I think does raise the baseline inflation rate because more people's pay goes up more rapidly, right? People just have stronger labor negotiating power. But the tariffs themselves, just like a tax at the border, that's not what increases the inflation rate. It's really faster pay gains for normal people that are raising up that baseline inflation rate. And there's trade-offs here, right? It's like, hey, we have to deal with a little bit higher interest rate, but normal people's pay is going up faster. We're also more self-sufficient in our supply chains. We have to worry as much about like China and Taiwan. I think these are trade-offs that people are increasingly more willing to make post-COVID. So generally speaking, guys, I just don't think tariffs are going to have a big enough impact to cause a recession in the United States. Most of what we buy in the United States is from each other. It doesn't get touched by tariffs. Even assuming all these tariffs go in place, it's a very small overall impact. I don't think they increase inflation. This stuff is a huge story today because we had a stock market correction and it sort of coincided with a lot of tariff announcements. I think tariffs add volatility. They add uncertainty, but they're not enough to crash the U.S. economy or fundamentally change things, in my opinion. So let's talk about something they could do maybe to offset some of this inflation, guys, because as I mentioned, I think reshoring, bringing all this business back home, that's obviously increased the baseline inflation rate. The Fed wants to get to 2% to cut rates. We all want 3% mortgage rates again in the United States, right? Something that seems like a distant memory. And so, hey, what can the administration do to actually offset maybe some of the inflation coming from these huge changes to global supply chains? One thing they could do is deregulation, okay? And, deregulation sort of has like a partisan connotation now, but I would just say, hey, we've had a period in the recent past where we did a major deregulation. It was bipartisan. And by the way, it happened when we were having a major supply chain problem. This was back during the OPEC oil embargo. And we had high inflation problems as well. It was the 70s and the early 80s. And so what I did on this chart, guys, is I just graphed out the total pages in the Federal Register. So think about like if we write a rule or regulation, they essentially get recorded in a giant book somewhere. And this is the number of pages in that book of rules and regulations. And I like this chart because, one, it shows you over time kind of what's happened with the regulatory burden in the United States. And again, it gives us like some good historical examples to look at. And so 70s, early 80s, Jimmy Carter and Ronald Reagan collectively cut regulation in the United States by about 50%. Okay, what did they deregulate? The trucking industry, ocean shipping, rail shipping, energy production. They got rid of the long distance telephone monopoly, right? Long distance phone calls used to be really expensive. They deregulated the airlines, helped make airfare much more affordable to the masses of people. And so the idea here was, hey, inflation's a problem. If we remove some artificial barriers to production, some of the red tape, right? All of a sudden, hey, it's more efficient or cheap to produce things. It's going to lower the cost of producing them, and they can pass that on to consumer and help deal with the inflation problem. So I think deregulation helped. I think globalization helped get our inflation rate low and stable the past 30 years. Ultimately, as well, hey, the 80s and the 90s post-deregulation are a pretty strong period of time economically as well. Now, over time, though, hey, regulation grows again. 2016, Donald Trump gets in office. They do a deregulation. It was actually fairly significant, but it didn't really stick. It wasn't very permanent, okay? For a couple of reasons. One is he did it mostly through executive orders, and those can be reversed by whoever comes in office after you. So Joe Biden reversed some of this stuff, right? But even more importantly, hey, we had a global pandemic, right? COVID added a bunch of regulations to the U.S. economy. And so we sit here today, we're basically, I'd say, back at a record high in regulation. I think you're going to see a deregulation happen under Trump round two. I think it's going to be bigger than the first term in office. I think it'll be closer to Carter and Reagan's deregulation for a couple of reasons, okay? One is they've got like Elon Musk in charge of this. They're using creative problem solving. They're using AI tools to comb through all of this. So think about how many people you'd have to hire to go through 100,000 pages of regulation with like a fine-tooth comb, right? Very difficult to do. Conversely, you just like, plug an AI in there and it can hunt through everything and find things for you in a really efficient manner. So 2 years ago, when AI became a huge story, I did not think the institution that would be disrupted first was the federal government. That just like was not on my bingo card, but that's happening, right? Number two, and I think even more important here, is that there's major Supreme Court decisions that have happened recently that essentially give them legal ammunition to deregulate, okay? I'm not a constitutional scholar, but I'll like summarize sort of for you guys, and feel free to fact check all this afterwards. But basically, what's happened is there was this idea of regulatory or bureaucratic deference. Okay, so most of the regulation you see added over the past 30 years here, since like 1990, has not been added due to Congress passing a rule or regulation. It's been added by three-letter agencies. Think the EPA, the SEC, the DOL. Okay. And they pass a rule or regulation. And then when it gets challenged in the courts basically side with the bureaucrats and say, we're going to defer to the experts on this. These Supreme Court decisions, EPA versus Massachusetts, the Chevron decision, basically say, hey, if you want to pass a rule or regulation, you have to do it through elected officials, because otherwise there's no recourse to the people to kick you out of office if they don't like this stuff. And so very quickly, a huge chunk of regulation over the past 30 years is now in a legal gray area, which allows them to repeal things in mass, okay? So what does this mean for the economy, guys? Hey, we have higher baseline inflation. The Fed's not going to be able to cut interest rates because of reshoring. We're not going to get to 2%. But if they can actually pull off some deregulation here, that could lower that baseline inflation rate, make the economy more efficient, also incentivize all this reshoring to continue. So one of the biggest problems we've had in the US the past several decades is just we don't build anything here anymore, right? Major infrastructure gets tied up in red tape for 5 to 10 years. Well, if we're going to bring factories back here and build roads to all those factories and build AI data centers to win the AI race and modernize the electrical grid to, make electric vehicles even feasible, build nuclear power plants, whatever, every individual project can't get tied up in regulation for 5 to 10 years before it breaks ground. So I'm fairly optimistic, guys, about the deregulation. I think we have a good chance of pulling this off. I think it speeds up economic growth, and it probably lowers that baseline inflation rate as well, just like we saw back in the 70s and the early 80s. Okay, so let me talk quickly about the budget. And frankly, guys, I think the US budget situation is much more concerning to me personally than like tariffs, right? I know tariffs are taking up most of the news space, but listen, I mentioned, hey, interest rates are really my concern this year. The market, your portfolio wants lower interest rates, generally speaking. That'll make your financial assets worth more, right? And one problem has been inflation's just been too high. So we've kind of covered that. The other problem is interest rates have just been really volatile, right? Long-term interest rates are supposed to be pretty stable when you buy like a US government treasury. The idea being, hey, you're going to get paid back. It's a really safe, liquid market. And so interest rates aren't supposed to really bounce around very much. And so when they do, it adds a ton of volatility to equity markets as well. And it's not just that interest rates have been high, it's that they've been bouncing around so much. Bonds are typically supposed to like tamp down volatility in a portfolio. The past couple of years, they've kind of added to volatility. Okay. It's because interest rates have been moving so much for like government debt. And one of the reasons why is, hey, the biggest institutional buyers of US debt have sort of stepped away. The Fed's not buying anymore. Foreign buyers are kind of net zero demand. They buy as much as they sell. And so it's mostly domestic investors in the US buying all of the US debt. And hey, the Fed will buy debt no matter what, right? If they're allowed to. They're kind of not able to because of inflation and the fact that they caused it during COVID. But normal investors like me and you, hey, if I see that the US government's budget situation is kind of out of whack, I'm going to demand a higher interest rate to be compensated for that. And so there's much more like market-based pressures on price. And you're seeing a lot more volatility because the biggest source of demand, the Fed, has sort of stepped away. And I think one thing that's made investors very concerned and caused a lot of volatility is just the fact that our budget situation in the United States looks unsustainable currently. And my favorite way to look at that is just interest cost as a percent of GDP. Okay. We're never going to have to pay off the overall debt, but we do have to service the debt, right? And I think what's relevant to ask is like, what percentage of annual production in the United States do we just spend on interest costs, right? That's sort of what this chart tries to show. And so the past 30 years, you see why nobody cared. We added $30 trillion in debt, but we refinanced it at a lower interest rate the whole time. The mortgage balance was going up, but the monthly payment was going down. So who cares that my mortgage balance is going up, right? Well, then COVID hits, inflation spikes, the Fed hikes interest rates. Now interest costs have spiraled upwards. We're still spending as much as we were at the height of COVID. We never returned to pre-COVID spending. The deficit's huge. And the orange line there shows you guys where debt costs are heading from here, even higher. Interest is now the single largest line item in the US budget, more than defense or Social Security or anything else. And so I think we're basically at a point where we have to address this problem. Things I think, by the way, can get better very quickly or worse very quickly. So, if Donald Trump just forces through a deficit expanding tax cut here and he doesn't pay for any of it, well, I think not only does the deficit get worse, but I think interest rates will go up because everyone looks at this situation and says, hey, nobody's even addressing it. I'm losing confidence here. I want a higher interest rate to compensate me for my risk. Conversely, we actually cut some spending and we make this whole situation better very quickly, okay? And that's what the Department of Government Efficiency is trying to do. Again, they're doing it with like AI tools, right? So it's very hard to wrap your arms around all this spending that's happening unless you have a way to map it out very efficiently. And that's what AI's done. A lot of talk about, hey, it's just Social Security, Medicare, Medicaid, defense, and interest. Like, you can't actually cut any of that. And I actually think that's just wrong. There's plenty of spending to cut in the US budget when you look between those major line items. Okay, so I'll give you guys a couple examples. About $500 billion a year is spent that hasn't been actually appropriated by Congress. Okay, just think like budgets have grown through like institutional inertia. Money's going out in so many different directions that nobody could really keep track of it. Guys, there's so many individual stories about Doge that I think wind up in the news. Actually, the most interesting one to me has been the fact that when the Treasury sends out a payment, there's nothing in like the memo line. Or at least there hasn't been. So $6 trillion a year goes out the window without anybody really knowing where it's going specifically, right? This is where all like those improper payments, the fraud, the abuse is coming from. So hey, I think that's a ripe area to find spending cuts, right? And I think they will. Guys, about $1 trillion a year in spending can be cut by just reversing executive orders under Joe Biden, okay, which Donald Trump has the power to do. What are these spending cuts that he could do? Think things like student loan forgiveness, and most importantly, wind credits, solar credits, electric vehicle credits under the Inflation Reduction Act. Very expensive, these things, right? Now, he hasn't cut any of this. Why not? It's because a lot of Republicans like this stuff. That's the bottom line. I live in Texas. We have the most wind power of any state in the nation. Republicans in Texas like wind power, right? Illegal immigration's been really expensive, about $200 to $600 billion a year, just based on what you include. And so, guys, I think there's plenty of spending to cut. They can get creative about it. They're able to like map all this stuff out more efficiently. If you look at the Department of Government Efficiency, they say they found over $100 billion in spending cuts already. If you annualize that out, we're going to find $1 trillion in spending to cut in the US budget. I don't think that's unrealistic. I think they actually can find spending to cut. Not only do they kind of want to, but I think we sort of have to, right? If we do that, find $500 billion or $1 trillion to cut, not only does the deficit go down, not only pay for the Trump tax cuts, but really most importantly, it injects confidence that someone's addressing this major issue, and then interest rates fall as well and become less volatile. And I think that would do a huge amount for the stock market, for volatility, for just general confidence out there as well. So I think this is the hardest thing that they're going to have to face, biggest challenge. But if they can actually find spending to cut, I think that's like the most important thing out there for me. I think the U.S. budget needs to be addressed. It's gotten kind of out of control here, and something needs to be done sooner rather than later. So I'll wrap it up there. I know we're right around like 30 minutes. I've got a couple examples of the pieces we put out at First Trust. Everything's one page or less, easy to read, easy to share. This stuff's all free if you want it. I think it's a good resource, guys. Thank you so much for being on the call. Really appreciate our hosts for having us. And I think we might have some questions, so I'm happy to hang out for those as well.
That's great. Hey, Bryce, boy, that's awesome. The way you explained it was perfect. Everyone, I think everyone's going to understand it. Is there any way, there's a couple questions I'm going to ask you from clients.
Yeah.
So is there any way the tariffs, if they do that reciprocal tariff where they're charged, like Canada charges what, like 200% on some of their dairy products?
Yep.
So and we're charging them 20. So if we said reciprocal, hey, you're going to charge us 200, we're going to charge you 200. And if they do that, then what they're going to do is they're going to lower that tariff right off the bat, right?
Yeah, exactly. And that's sort of like the idea. I don't think the goal here is to just leave tariffs in place long term for most stuff. Now, maybe for like things like, hey, we want to make semiconductors in the US, or like, we want to make our own antibiotics here or something, right? Maybe those tariffs do stay in place permanently, but most of what this dispute is about, guys, is like, generally speaking, you look at the past 80 years of economic history. The United States has unilaterally, meaning we lowered our tariff barriers and we didn't make anybody else lower theirs. We just unilaterally lowered tariff barriers and opened our domestic market to everybody else. The idea here was like, hey, part of it was fighting communism, frankly. It's like, hey, we want you to be on our side. So if you choose us instead of the Soviets, you get access to US consumers. We'll give you technology, all this stuff. Get on our boat here. But there's just like a lot of, post Cold War, a lot of mismatch around the world. And you bring up like the Canadian dairy, that's like one example of like 1,000. There's a lot of countries like China, right? China has tons of tariffs and non-tariff barriers, even though the United States doesn't have a ton against them. Same with like Japan, same with Australia. So I think you're right. It's mostly about like reciprocity, or like what they would call fair trade. If you're going to have a 200% dairy tariff on us, we're going to tariff your oil. We're going to tariff something else until that goes down. So I think that's mostly the goal here, especially with allies.
And can tariffs help reduce the debt at all, or?
That's the part where like I don't think tariffs are going to be a huge help there. Okay, for a couple reasons. One is tariffs do raise revenue, and that's why I kind of personally favor them versus like industrial policy. Instead of money going out the window to change incentives for production, money's actually coming in. But it's a pretty small amount of revenue you end up raising. I think like the current estimate is like if we put all these tariffs in place that Donald Trump's proposed, we maybe collect $100 billion a year. Now, that's a lot to all of us, but that's about a third the cost of just extending the Trump tax cuts, right? So I think ultimately it's not about raising revenue. We don't have a revenue problem in the United States when it comes to our budget. It's really a spending problem. Like we collect an extra $100 billion, then we spend an extra $300 billion. So it's the spending side of things that I think needs to be under control here.
Yeah, yeah, and the other, President Trump, he wants to stop all the, like taxes on income under $150,000, no taxes on Social Security, no taxes. But in order to do that, they're gonna have to find a lot of money to offset that, or it's not gonna pass, right?
Yeah, so like doing something like that would be extremely expensive,
Yeah.
right? And I'll just tell you, like, I don't know the specific numbers, but right now in the United States, okay, if you look at the top 10% of income earners in our country, for all the talk about like, hey, the wealthy need to pay their fair share, just the top 10% of people pay like almost 50% of the income tax in the United States, right? They pay the vast majority of it. So top 10% is going to be like $200,000 plus. So immediately, like that proposal, you lose half of the income tax revenue in the United States. It'd be like back of the envelope math in my head, right? So huge amount of money that would cost. I find it very difficult to see how we do that with like tariff revenue instead. I don't think that we need to be focused on like, hey, eliminating taxes as much as we just need to like, maybe people just need better jobs in the United States. Reshoring probably helps with some of that.
Or cut spending down, like you were talking
Yeah,
about.
or cut spending, and yeah, exactly, and pass on the cost savings from spending cuts to people. And I agree, right? It should be at the lower end. You should target most of this. Double the standard deduction again, or something like that. Eliminating all income tax, so I think would be really difficult to do.
Yeah, I don't think that's so we'll give you two more questions. So crypto right now is it just seems like it's been going crazy. Obviously it's very volatile. Our clients ask about crypto. We do have a ETF with some crypto in there, but very little, 2%. But what's your thought on crypto? I always said, the Bitcoin was very, what people liked about it is no one knew what you were buying. But if they make it where it's regulated, like it's going, then it's not anything special, is it?
Yeah, so man, there's so many different ways to go with cryptocurrency. I'd say, like, listen, you're right. Like post 0809, Bitcoin gets created by a guy named Satoshi Nakamoto. Nobody knows who he is. The whole point is to like create a digital asset with decentralized property rights that, hey, the Fed can print all the money it wants. Like nobody can create new Bitcoin, really. There's a fixed supply. And so, yeah, all of a sudden, it's regulated by the federal government and everybody's being taxed on it. Like some of that like anonymity or like encryption around Bitcoin, that value proposition goes away for us in the United States. But I think what's important to remember about Bitcoin is like probably most of the benefits to Bitcoin actually accrue to people outside of the US, right? It's like people from like Venezuela or like Russia or China who want to move their money around. Those are the people that benefit the most from like Bitcoin as a currency or like a currency alternative. Here in the United States, we're kind of like we're buying it almost as like digital gold or like a new speculative asset class. And so I think that's kind of what it is for us. It bounces around too much to be a currency. I'm frankly like pretty optimistic about cryptocurrency, especially like the big ones, right? Bitcoin and Ethereum. I wouldn't buy like Melania coin or Trump coin or Haktua coin or whatever, right? There's always like, there's a lot of pump and dump schemes. But generally speaking, I'm pretty optimistic about cryptocurrency. I think it's going to become more available. I think younger generations do see these as legitimate assets. I think they're sort of cemented into the system. I think this stuff's eventually going to be in people's 401ks. So just from an access perspective and a demand perspective, I think the price will probably go up. It's still going to be volatile, though. I would not recommend this being like 50% of your investment portfolio. Like a lot of people in Austin, I know, right? Are like, they talk, they don't stop talking about their Bitcoin until there's a crash. And then I don't hear from them for like 6 or 12 months or something. So I'm fundamentally pretty optimistic about it, but I don't think it will replace the dollar as a reserve currency. I think most of the value is actually for people outside the US for getting around capital controls and getting out of currencies that are being debased by central banks.
Okay, last question was about gold, and I always said I've been saying this for a long time. Gold is good for jewelry, and it's not really a good head. It's never if you look at the volatility of gold and then the actual return of gold over the last 40, 50 years, it's like T-bills. But lately it's had a run, so people are jumping on it. So how high do you think, is gold gonna just keep going? Why is it going up so fast right now? Is it the dollar?
Yeah, so basically, I used to tell people to buy gold for like two reasons. One would be like you think the end of the world's happening or something, right? It's you want to have like gold bars in your safe or something. The other is like global central banks are printing money, right? And so typically when that happens, commodities like gold go up in value. So I call it Bitcoin digital gold, right? It's the same idea. It doesn't matter. You can print dollars, you can't print gold, right? Recently, though, and by recently, I mean really over the past, like, I don't know, 4 years or so, I think there's sort of a new, I guess, value proposition for gold or like argument for gold. And that's that gold is what we call like a neutral reserve asset. Okay. And I think as we see the world deglobalize, okay, it's important to understand post World War II, the US dollar became the reserve currency for the world. We sort of built like this global trading system on the dollar, on US treasuries, and people mostly were happy to do that. And the reason why was the dollar was almost like a neutral reserve asset. You buy dollars, you hold dollars, you get paid interest on the dollars. What's happened is over the past like couple decades, the US has used dollar holdings as a way to like exert leverage over other countries, right? Through sanctions, through everything else. I think this really came to a head, especially when Russia invaded Ukraine. We confiscated, I think, like $600 billion in their Forex reserves. And so the neutral status of US Treasuries, basically, I'm going to buy US Treasuries and it's just going to be like my property that I get paid interest on. I can use it to buy whatever I want. That's kind of been called into question, especially at the institutional level. And so especially in places that are like geopolitical rivals, think like China and Russia, they've been selling treasuries and buying gold instead. And the idea is, hey, if we want to do trade between Russia and China, I don't want yuan and you don't want rubles. And so we need something neutral to, I guess, clear our trade balances with. Gold is like still a pretty good way to do that. And gold has no ulterior motive. Gold has no quid pro quo attached to it, right? If you do it with dollars, hey, maybe the US doesn't like something you do, they can exert political leverage on you. You can't really do that with gold, right? And so central banks are starting to buy it again. It's becoming more and more in favor with, I guess you call it like geopolitical rivals to the United States, and even countries that just kind of want to diversify their Forex holdings as well. And so I'm not saying the dollar's going away as a reserve currency at all, but I do think that you're starting to see gold pick up some of the slack here. And so I do have sort of there's sort of like a new fundamental source of demand for gold that hasn't existed for a while. So I don't think gold's going to have like a giant, it's going to go up 100% or something like that, but maybe just a little bit more slow, steady growth. Typically, what happens is gold just kind of treads water, and then there's like a major event, right? 2008, 2009, gold gaps up. COVID, gold gaps up. Those are the types of events where you typically see gold have a huge return. Now I think gold has like sort of like a little bit more steady tailwind to it.
Gotcha. All right. Well, listen, we want to thank you for coming on and sharing your knowledge. It was amazing. I'm sure everybody got something out of it, and we're going to I'm sure have conversations over it. We took good notes over here, so thank you for your time, and we'd like to do this again down the road with you.
Yeah, absolutely, guys. Anytime I can help, I'm happy to do it. It's been great being
So
with you.
last question. So the this year you see the S&P doing positive return or NASDAQ?
So we came into this year with a price target about like 5,400 on the S&P 500. So I think we're the only firm on Wall Street that was bearish on the market heading into this year, right? The reason, again, it wasn't that we're worried about profits. It was interest rates were just high. I think that we're going to see interest rates go back to 5%. That's sort of my personal opinion. I think part of this is just a short-term scare over tariffs that's not going to play out. And so I think there's possibly a little bit more downside to the market here. But generally speaking, we've had a correction. I feel more comfortable about market valuations today than I did 3 months ago, right?
Good. I like it. Okay. Thanks again, Bryce, and Theo, thank you, and we'll talk to you real soon.
All right,
Bless
guys.
you.
Have a good
Okay,
one.
bye.